Perfect.
Finally, it's certainly been long enough, hasn't it?
It has. But we've been nice and busy, so that's a nice positive note.
Yeah, definitely. I was just, I think me and you were speaking off air, and it's been a good few months since we've done a live chat between us. All the video content going out, it only made sense to get on and speak to the public and let them fire away while we're live. So yeah, thanks for joining me, Akhil.
Oh, you're welcome. Thanks for having me.
So anyone that's listening, this is Akhil from Our Mortgage Broker. If you have any questions at all, please feel free to fire away in the comments. We'll answer them live while we're here. We have got a number of questions that's been fired away on Facebook and LinkedIn, so we'll get into those as well. But just before we do that, if you just like the post and send a comment just to make sure you can hear us loud and clear if possible. And going into it, Akhil, really, just really wanted an overall update, if that's okay. There's a lot going on around the world, and starting off then, what's going on in the mortgage world? Is it slowing down, remaining strong? Are any lenders pulling any products from the market? Can you give us a smaller overview?
Sure. Well, thank you for having me once again, Tristan, on the landlord page. So what we're going to do is probably base this conversation around the landlord side, so all around the buy-to-let market. If anybody has any questions around the residential piece, do let us know. But just to give you a quick introduction, we are an independent and whole of market mortgage brokerage. We're based here in Bracknell in Berkshire. We've got a team of mortgage brokers in and around the M25, but we help arrange mortgages and insurance for anyone in the UK. With regards to your question, Tristan, yes, there is a lot going on in the market with regards to things outside of our reach. In particular, you've got the Russia and Ukraine war. You've got the loose ends of Brexit. You've got the loose ends of COVID now as well. So it's all happening. It's never a dull day on Sky News or BBC News and the alike. So it does certainly have a bearing on the mortgage market. And the reason why I say that is wars, pandemics, recessions do have an influence on inflation. They do have an influence on interest rates. So you've got to be mindful of the global issues that can have then negative effects on interest rates. So there is certainly a topical, a topic that is widely spoken about. We're due to hear from the Bank of England governor any minute now with the interest rate, either a rise or a standstill. I'm predicting a rise, and I've just got it. It's just come through. It's risen to 0.75. So breaking news, it's just gone up from 0.5 to 0.75. So as you can clearly see, we've had 3 increases in a short space of 3 or 4 months now with the Bank of England. The US increased their rates yesterday after 4 years. So it's certainly on the way up. We always advise our clients, you should be reviewing your portfolios sooner rather than later. If you've got any mortgages coming up in 2022 for renewal, certainly get in touch with your brokers or someone like ourselves at Our Mortgage Broker. We'll give you a free, no obligation review of your portfolio and just ensure that you are on the right deals.
Perfect. Thanks for that, Akhil. So you touched on it briefly about what's going on around the world and how interest rates will go up. But the other day, I received a weekly update just with regards to buy-to-let mortgages and residential, to be honest with you. Mm-hmm. Although there's been a slight increase over the last couple of months, it's still very, very competitive for the buy-to-let deals at the moment. So the Mortgage Works announced 2 products. One is 75% loan to value, 1.19% over a 2-year fixed. And there was another one with 60% loan to value at 1.09%. Do you see this having an increase based upon today's announcement and just what's going on?
Well, the stock market's usually the best place to go to, and what they do is they foresee any changes going forward. And it doesn't take an Einstein to work out that interest rates will have to go up to combat inflation. More importantly, and it's not just the war in Russia and Ukraine that's going on that's having a detrimental effect on inflation. This is because of the quantitative easing over the so many years that have been going on now. You've got supply and demand issues. So that's having a negative effect, I should say, on inflation, which means that the Bank of England have to increase interest rates, hopefully slowly rather than sharpishly, to hopefully reduce that inflation. I do think it is short-lived, this inflation. I think we've got, obviously got the war, you've got the supply and demand issues, you've got the cost of living that keep creeping up. But I think hopefully it should calm down within about 18 months. And it will certainly come down to the 2% target. But I think at the moment we're about 7% at inflation, which is it's over 3 times where our target should be. So with regards to interest rates, the market is factoring in an increase in rates. There's a lot of lenders in the market that are increasing their rates in their buy-to-let product range. Some are withdrawing rates, some are increasing rates. Now, this is an everyday topic, and we get advance notice of any changes with all the lenders in the market. So that's another advantage of speaking to an independent broker. Now, there's two things you have to bear in mind here. If you are a tracker rate mortgage or on a variable rate mortgages, the changes that have just happened a few moments ago will take into effect probably next month, and you'll see an increase in your mortgage payments. However, if you are on a fixed mortgage deal, your payments won't be affected with changes that go up or down. So if you're tied in, no changes in your mortgage payments. If you are on a standard variable rate, a tracker rate, you are going to see changes, and it will be negative, unfortunately, on cash flow, probably from the following month in April. With regards to rates, they're still very, very competitive, and I say that very positively, because if you just rewind about 9 months ago, limited company buy-to-lets, were 3.5%, 3.75%. Now they're at sub 3% on limited company rates, which is fantastic for the buy-to-let investor, whether they're new into the limited company space or they're further growing their portfolios.
Why do you think this is, Akhil?
Why do I think the rates are still low?
For limited companies?
Okay, great question. So limited companies are funded in different ways. Now, limited companies are not your traditional banks more often than not. So they're funded by ways of using hedge fund money, high net worth individuals, and securitization. So they've bought that money on the basis that they can lend it out at a certain rate and they can make their certain spread. And they've tied that money up for many, many years to come. Whereas high street lenders are a bit more vanilla, a bit more cautious, and they're a bit more aligned to their banking rules and regulation, if you like. So they have to then comply with their shareholders that they have to adhere to and make sure they're meeting dividend payments and so on. So there's two different sides to buy-to-let. You've got the personal name buy-to-let mortgages, you've got the limited company buy-to-let mortgages, and then by the side of that, if you like, the extra layer is, where do those lenders stand in that market? Predominantly, a lot of the lenders on the high street don't lend to portfolio landlords, or they have a very stringent criteria. Whereas the specialist lenders, and specialist doesn't mean very expensive. What it does mean is very flexible, very pro landlord, very pro buy to let. And if you look at the numbers in terms of the interest rates, the difference between a personal name buy to let and a limited company buy to let rates are somewhat being squeezed, which is very, very positive for any landlord.
Perfect. And am I right in saying when you do a quote for a client, you do both limited and personal as well for a buy-to-let?
Yeah, I think that's the right thing to do for our clients. Even though our clients want a limited company buy-to-let mortgage, we insist on providing both options, just so they understand what the costs look like and then they can compare apples with apples. And again, we're not tax accountants, we're not advisors on the tax side of it. We do suggest taking up relevant tax advice, especially if you are owning 4 or 5 or 10 properties or more, and or if you're a high rate taxpayer, because that could have a huge negative effect, especially around Section 24.
Yeah, definitely speak to an accountant or tax specialist on that side, because there are benefits to both depending on circumstances. So bringing on to my next question, Akhil, Skipton International announced recently that they were removing all their products that were properties with EPC ratings less than a D, and only properties that would a D that could bring up to a C standard, in line to the potential changes in 2025. Yeah. Do you expect other banks to follow suit, or where do you see this going?
It's a great question, and it's on everyone's radar from a perspective of lenders at the moment. Now, what I would say is there is a paper that's gone out with the government around the new EPC changes that potentially come into effect from 2025. And what that means in short is any new tenancy from 2025, your property must have an EPC rating between A to C. At the moment, it's A to E. If you haven't, for example, if the changes do take into effect from 2025, if your property doesn't have a rating A to C, you're not going to get a buy-to-let mortgage. Now, at the moment, lenders are conscious of these potential changes that are going to take into effect. And what they are doing, they're introducing buy-to-let green products or buy-to-let favorable products based on the EPC rating. Now, you are quite right to say Some lenders are taking a bit of a negative view on it, or taking a more of a cautious approach, I should say, on the EPC side. So from an investor's side, I would suggest buying properties that have an A to C rating, or if you are acquiring properties that have an E or a D rating, be conscious of the cost and the implications of changing that property from an E, for example, to a C, because one, you'll benefit from preferential rates with the A to C green range, and potentially 2025 is only around the corner. You want to ensure that you can get a buy-to-let mortgage, because you could become one of those new mortgage prisoners. There's lots of conversation about mortgage prisoners, and that could be the next issue coming up tomorrow, or I should say in 2025. But with regards to pulling out of the market, adjusting the EPC criteria, yes, lenders are certainly doing that. They haven't, I would say they're doing it cautiously, but they're doing it in a positive manner, where they're offering those preferential rates to the A to C properties. And people that are acquiring properties that have only been built in the last 10, 15 years, usually those properties do have an A to C rating. It's the 1900 properties that are going to have the bigger issues, I should say.
So still very positive then, just playing it by ear, I suppose, but obviously with the announcement still early stages. But I mean, let's be honest, it's not official, but it pretty much is, isn't it?
Well, listen, it's not in black and white yet, but as landlords, as investors, you've got to be conscious of the future, because you're in this for a long game at the end of the day. So plan for the future, I say.
Definitely. And then going on to some questions then that I've received on socials. The first one is from Neil. He wants to know, what's the thoughts on buying a cheaper buy-to-let up north or more expensive properties down south, yield against capital growth, etc.?
This comes up weekly, daily in our offices with our clients asking us, should we buy it further up north or should we buy in the south? The short answer is this, and I tell all my clients this, is the key here is to understand, are you after capital growth or yield? Yield means cash flowing properties, cash flowing buy-to-lets that are positive, and you have a net surplus income which you can save towards your next purchase. The key here is to understand, first and foremost, how much money have you got in your pocket, and how far does your deposit stretch you in order to buy a property. So first and foremost, you need typically 25% deposit to buy a property. Do you buy it up north? Do you buy it down south? The question here is, it's all about the management of that property first and foremost. So let's assume you've got the deposit. Who's going to manage that property? What does a cost look like for managing that property if it's 200, 300 miles away? And have you got the maintenance people to cover those maintenance issues and any other issues that have within that property? So you've got to think about time and the cost of maintaining that property, as well as agency fees as well. Now, it is very, very noticeable. The yields further up north, north of Birmingham and upwards, I should say, the yields are certainly much better than London and the southeast. Typically, it's 2, 3, maybe 4% in the southeast, in London and the home counties. Whereas further up north, as I said, Midlands, northeast, northwest of England, yields can go from 5 to 8%. If they're HMOs, they can go from 8 to 12% as well. So you've just got to be conscious of what you want from your investment. Now, if you are setting out, and I'm looking at those potential clients that are looking to move into buy-to-let and buy their first one, what I would say is look for cash flowing properties, just simply because cash is king, and cash will then enable you to scale your property portfolio. So it's not just about north or south, it's actually about where you're at, what price are you able to buy a property at? Is there a value add opportunity? And then can you refinance at the new market value in order to take the equity out in order to go shopping again and buy your second and third property? That's the key there, I would say. It's not just about north or south. It's that BRRRR strategy. You're buying it, you're refurbing it, you're refinancing it, and you're renting it. And that's a great, great strategy. Whether you are entering the buy-to-let market or as a seasoned investor, if you're looking to scale, you must use that BRRR strategy. The good thing about properties down south is capital growth. If the UK sees a recession, London will always go down in value first. It's like the pandemic, everyone rushed out of London. But what you do see on the flip side is, and if you look at house price growth, we're at the average house price of about 270,000 in the UK. London's obviously a lot more than that, simply because of being the capital of the country, is you get capital appreciation with yield. Some parts of Northern England don't see a capital uplift. You do see great yield. So for your listeners, for your viewers out there, be conscious of the capital growth. Does it have an opportunity to grow in value? And that's where the research and the due diligence comes into play. So there's no right or wrong. In short, North and South is certainly both good territories to invest in, but be conscious of your time, being conscious of the uplift in values, and how quick you can scale your portfolios.
I think it's worth adding to that. So we had a podcast with SDL Property Auctions, and the one thing that's come up in a few of our podcasts is to do your research, and you've sort of reiterated that on both of your podcasts. Do your research of the property. Is there a market? Who are you aiming to target your property to?
Yeah.
Because they've had cases where people have decided to buy up north because it's cheap, paying 30, 40,000 for this property that they think they're going to let out, but there's not a market for it because it's just so cheap. So someone's brought it cash to have it on the basis that they can't rent it, and now they want to flip it because they're not making any money. Property's not going up in value either. So definitely do your research, check with the agents, find out what rent you're going to achieve as well on that. So yeah, thanks for that, Akhil. I appreciate that. So next question we've got is Andy. How easy is it for first-time investors to buy a new flat to rent out?
So what was that? Missed that bit. What's the first bit? Sorry.
How easy is it for first-time investors to buy a new flat to rent out, so a new build?
Right. So first-time buyer, first-time landlord is not a problem. So you don't need to own your main residence to buy a buy-to-let. Let's get that myth out of the way. The other myth that I wanted to share with you is you can buy a property in a limited company immediately. It doesn't need to have a track record of being established or registered. In order to buy a new build apartment, not a problem as well. There are lenders that lend in the new build space. If it's for a buy-to-let, up to 75% loan to value. There are a few lenders in the 80 and 85% loan to value as well. But what you've got to be conscious here of is it's not just about the rates and the arrangement fee for the mortgage. There's other criteria that you must meet as a buy-to-let investor. Some lenders have no room for any adverse credit. You might have a missed payment on a mobile phone bill, that sort of stuff. So you just got to be conscious that you've got to meet other parts of their criteria in order to get the mortgage. But certainly new build flat mortgages are certainly available, no problem whatsoever. So, and the beauty is, as I said, 80 and 85% loan to values are back in the market as well. So it's a very positive sign. And these rates, these loan to values, I should say, have been around for quite some time now. So it's a very positive market, and it's clear to see that lenders have appetite, and certainly see the PRS sector, the private rental sector, I should say, is certainly going to be buoyant for the remaining for the foreseeable future.
Thank you. And then we're moving on to Georgina. It sort of goes in line with this, really. What's the best piece of advice you can give a first-time investor that's looking to purchase a property?
Do your research. Do your research. Do your research. That it's very easy to say to do your research. You know, do your due diligence around what types of properties are in demand. Are they HMOs? Are they student lets? Are they family lets? Look at the void periods. How quick can a property be tenanted, or how quickly can it not be tenanted? Look at the duration of your tenancy. How long are people staying in those properties, and why are they moving out? So if you're buying a property that needs work doing to it, make sure you are going to dress that property and throw the kitchen sink at it in terms of decorative order, good amenities, good facilities within the property, because you're going to get a longer standing tenant in there. And don't be frightened to spend a bit of extra money on a property, I would say, because you're going to get a better tenant, and that will then demand a better rate of return on your investment as well. So do your due diligence, speak to local agents in that area and ask them, why is the property on sale? What's the demand for the property? And as I said, ask questions around the duration of the typical tenancies, and how long is it in between in between tenants? How quickly can it be tenanted?
Perfect. You get out what you get in, essentially, but definitely do your research. It's a massive part of that, and something we always say. So if anyone needs any advice, have any questions regarding the property they've seen from a buy-to-let point of view, then feel free to send me a DM on social, which is the landlord page. And then moving on to our final question, Akhil, is from Ian. He's basically said, I would like to know if there's any value in looking at small commercial buy-to-lets and holiday rentals in the UK.
There's certainly value in every single type of property in the UK, and the simple evidence of that is looking at house price and growth over the last 30, 40, 50 years. Now, the type of buy-to-let investment that you go for, that'll be specific to that town itself. Ian's mentioned, holiday lets, and the best example of that is, where did everyone go to in 2020 and 2021 here in the UK? It's got to be, beach destination, coastal, and good towns that demand holiday lets, where there's amenities there for the kids and families to enjoy themselves if they can't travel abroad. So I certainly think, I think we've done a video in the past about this, is having a balanced portfolio with different types of buy-to-lets within your portfolio. And this is for those investors that have got, larger portfolios, deeper pockets, and been in the game for quite some time. Because what you want to do is take an average of your portfolio, and you don't want to just have a load of single lets. You don't want to have a whole load of HMOs. You don't want to have a whole load of holiday lets. You want to have a varied portfolio, just so you can hedge your bets. And what happens there is you have an average good yield basis as well. So you've got to be conscious of the costs of holiday lets, the void periods, but again, the positive yields that you get out of holiday let properties. So taking an average of the types of investment properties, and again, the interest rates as well. Don't just think about, oh, I'm going to pay 3% here, 1% there, 4% there. Look at what the average rate of your cost of borrowing is across your portfolio. That's key as well.
Thank you so much, Akhil. So that's it from today. If anyone's got any question at all regarding anything we discussed, or there's any further questions, we will keep answering those in the comments. So feel free to send them over. Thank you very much, Akhil.
Thanks for having me, Tristan. All the best.